Great. Thank you, everybody, for joining us today. I'm Erin, and I will be presenting this webinar. As was just mentioned, if you guys have questions throughout the webinar, feel free to ask, and we'll do our best to answer them as we go along. And then also questions at the end, we can address those as well. If you have any problems hearing me or have any technical questions, again, make sure that you send those questions along the way throughout the webinar. We're excited to have you guys participating today, and really the goal of this particular webinar is to get you prepared for some of our classroom courses. NBC provides training and professional certification, which many of you may already be familiar with. And most of our courses, all of our courses really, are offered to give participants skills and knowledge to successfully facilitate housing and economic development in communities where everybody lives and works. So we really are offer quite a variety of courses, both in the classroom, through the webinars, and we also have what we call our NBC Academy, which is coming up in May. And NBC Academy is an interesting forum for us, because it gives everybody just this, brief little 2 to 3 hour courses to give people an idea of what our bigger in-depth courses offer. So our purpose for today, again, is to get you guys prepared in a 2-hour session for our classroom courses, specifically HD 410, which is our home ownership finance course, and HD 420, which is our rental housing development finance course. And both of those courses, the first one mentioned is a 4-day course. The second one mentioned is a 5-day course. So keep in mind that the information we're giving you today is to give you a brief overview and get you familiar with some of the housing and finance terms that will be used in those much more intense, longer courses, and give you some basic tools and techniques of housing development finance. We're going to try and sharpen up everybody's math skills today using some algebraic equations, and just get familiar with some of the numbers so that when you do get to the classroom courses, you're a little bit more familiar with some of the terms that are used. Okay. So why do we develop affordable housing? We're really looking to develop affordable housing to create decent, safe, sanitary housing. We're looking to do this, obviously, for affordable, low and moderate income people. And really what we want to try and do is integrate affordable housing into the communities that we're working in along with market rate housing. So we're looking to establish a market that has a mix of incomes and really improve these communities through attracting private investment into the underdeveloped areas. And today we're going to talk about 2 types of housing. We're going to talk about both rental and ownership. So we're going to start off with talking about affordable rental housing and the development process. The development process is where everything gets started. So going from an affordable rental housing project concept to an actual completed and operating development, there's a lot of different players that are going to be involved in a series of steps. So we'll go through all of those. Our key players here, the number one key player obviously is the developer. This is the person who's really coming up with the original concept. This is the person who's going to get all the other players to really buy in and be excited about their idea. This is the person responsible for doing all of the legwork. They're going to find all the financing. They're going to oversee the development. So this person really has to be the person to get everybody else to buy in, and they've got a lot of pressure on their shoulders. Once the developer has their idea, the lender is going to be obviously a key player because we have to find a way to pay for this development. So our lenders are going to be our typical banks. Lenders are also going to possibly be some sort of subsidized financing, some sort of public funds, and really the lender is going to provide the bulk of the financing for these projects. Our investor is another key player in the development process. Depending on the type of the deal, the investor may be bringing equity into the project. We also have our appraiser, and our appraiser is a key player because this really establishes the value that our lender is going to lend against. And so when we're creating our development budget and determining costs, obviously the appraiser is really going to be a key player here. We also have our architect and engineer and our building contractor, and both of these are, again, key players with our development budget and determining costs. We're going to be looking for getting bids from these people and evaluating experience. And that's a real key here with affordable housing is, as many of you may already know, when you're dealing with different types of programs that are out there with affordable housing, there's definitely key deadlines. So making sure that you have an architect and a contractor who understand the type of project and the deadlines that you're up against, and obviously to just keep the construction moving along, you have to have an architect that has some good experience and can continue those construction jobs and not hold anything up. The next key player is our market analyst, and this really is going to be the person who determines the profitability of the type of project that's being considered, whether that's going to be a success in the area and whether it's really a need for that area. And then, of course, we have our property manager, and this is the person who really, once the project gets completed with construction, is going to continue the operations of the project, as well as any continuing compliance that was signed up for with any of the programs for the affordable housing project. And really, when you think about it, we're developing affordable housing for the tenants that are coming into these rental homes. So the first person that most tenants are going to see when they come to our project is the property manager. So this really is the face of our project. So it's really another key player in the development process. So the steps in our development process, obviously starting off with the concept. Again, the developer is really the one that's going to get all the ideas and formulate the concept for improving the community with the affordable housing projects that we're working on. They're going to test the market. They're going to test the concept. Is it really going to work in this area? Again, is there another new project that's going into the area that's serving the exact same population and being built at the same time? How much room is there really to absorb this particular project? How much need is there for these units? The different size of units, whether we're looking at an area that really would benefit from one-bedroom units versus an area that might benefit from 2- and 3-bedroom units and have more families coming in. So again, really testing the market concept and figuring out what's going to work for a particular area. Obviously, we'll also have to look at site and design constraints and estimating the cost of construction. When we're looking at site and design constraints, depending on if it's new construction, is the property properly zoned? Is it zoned for housing? Is there any environmental issues that need to be addressed and taken care of? If it's an existing building that's going to require rehab, what kind of things are going on in the building? Is it currently being occupied, or is it a vacant unit or vacant building? If it's a vacant building, there's going to be typically some unexpected items that may come up during construction. If it's a historic project, a lot of times, there can be some local support to get that historic project up and running and converted over to housing. So, again, there's a lot of different things to look at with the site and design constraints. Then our next step is to develop the pro forma and income and expense schedule. So what does this really look like with this development? Can it bring the income? What expenses are going to be associated with that? To determine the cash flow. What kind of debt and equity can really be attracted to the project? And then from there, preparing the initial sources and uses of funds. As many of us have experienced with the way that the economy has been the last few years, there's a lot of creative financing out there. So a lot of times projects may start off with an initial sources and uses, and the sources of funds may change drastically. So, finding programs that are going to work for your project, and with a lot of projects, a lot of programs right now are new, trying to work through the different regulations and the nuances of those programs and really learning those new programs to be able to utilize them in your project can be very difficult. And there's also older programs out there that are either not working anymore, or there might just be general hesitancy of lenders in the current marketplace. So just keep in mind that preparing your initial sources and uses of funds, those may change as time goes on. Okay. The key here on this slide is that we're looking at obtaining our financing. So we're looking at permanent and construction financing. So keep in mind that permanent financing is always obtained first before the construction financing, even though construction occurs before operations, which is when our permanent financing is going to come in. So our permanent financing is our long-term first position mortgage. It comes in first, again, before construction, and it's really based on the pro forma and the income stream of the project. So it's based on understanding what this project might actually be bringing in and the income to pay that mortgage. Second, we would go out and find the construction lender. So the construction lender is going to get their loan paid off by the permanent lender. So they want to know who that permanent lender is. They want to know what requirements that permanent lender is going to have to be able to pay off their mortgage. They also may be getting paid off from some pieces of equity. So really they want to know what kind of risks are involved if the project doesn't finish. They want to make sure they're not going to have all their money in first. They want to know who all's money is in when, and they also are going to look at the contractor, make sure that the contractor has the experience to finish the job so that that permanent lender can come in and pay off their loan. So once that happens, obviously there's going to be tri-party agreement, and that's really based on whose money is going in when, who's paid first if there's a foreclosure. So again, just agreements amongst the different people that are involved with putting money into the deal, and if something goes wrong, who's going to get paid first. Then obviously construction of the project is going to come along next, and again, this will really just depend on what type of project's being completed, whether it's a new construction, a rehab, a historic project, if it's a smaller project, a larger project. So, this can be probably on average, between 9 and 18 months, just depending, again, on the type of project. Then managing and operating the property. So depending on the type of property, again, we talked on the previous slide about how important the property manager is. So depending on the type of project, if you're building a project that has supportive services, definitely having an experienced service provider and case managers on the project is going to be important. If you're building an assisted living facility, making sure, again, that there's an experienced service provider for the type of property and that can continue all of the operations and the compliance that go on during the operations phase. And then we have on the last step here of disposing of the property. Really, even though this is at the bottom of the list, it's very, very important to look at the beginning. Ultimately, knowing who's going to own the property in the long term, if there's any long-term compliance or periods of affordability that you've signed up for to build the affordable housing project. For example, a low-income housing tax credit Section 42 project is going to have very long-term compliance and requirements, periods of affordability that are going to run with the land. Any home programs can easily be 5 to 15 years, CDBG. So just depending on the types of programs that are involved on the property, the disposition of the property is very important to look at early on and not as it comes down time to actually dispose of the property. There's many a times, especially if it's a low-income housing tax credit project, there's going to be a partnership formed for the affordability period of that project, and once the affordability period is out, that partnership, the investor is going to exit the partnership. So they no longer want to be involved in the project. So it's really important to look at how the developer is going to take over that part of the partnership at the proper time and continue the compliance that's going to be required. So the next step that we'll look at is the development budget. Obviously, we need to know how much is it going to cost to build this project. So looking at the development budget or the actual uses of our funds. So itemizing all of our construction costs, all of our capital costs to actually complete the project. Some of the items for the development budget are listed here. some of the major items. Obviously the land, and whether that's the land, again, is a new construction site or if it's an existing building. You have to look at the land and what is going to go into that project, what's going to be required to gain access of that land if it's not already owned by the developer. Site improvements. Again, looking at zoning is a good example here. If it is a new construction project, is the utilities that are required for that already out at the site, or do those utilities have to be brought out? That's going to be a cost. And again, environmental, and that's really a big piece that's probably increased in the requirements and is seen more and more as a requirement by many, many lenders that an environmental phase 1 review is done on site. So that can always bring additional costs to completing these projects. Looking at the construction contract, looking at the construction contingency, our contingency is going to cover any unforeseen or change orders, and that's always going to be standards built into a construction contract. The percentage of the contingency is going to be a percentage of our total construction contract, and that's just going to vary, again, depending on the complexity of the project. Our architecture and engineering fees are going to be built in here. So our construction interest, so this is just the interest on our loan during the construction period. That's going to be part of our development budget. And reserves. So the reserves that we're looking for on our development budget is really typically our rent-up or our lease-up reserve. So what's going to be required to meet our lender's debt coverage ratio, which we'll get into more detail soon, during that lease-up period so that we can pay our debt service, we can pay our loan to our lender during the rent-up. And then obviously the developer fee. Again, the developer being such a key in this process, they're, responsible for an awful lot and obviously in this to earn at least somewhat of a developer fee for the work that they're doing. So let's do an easy exercise or quick exercise here for construction costs. Construction costs sometimes are expressed as a per unit cost, sometimes as per square foot cost. So in this particular exercise, we're going to assume a rental housing project has the following parameters. We've got 40 units. They're all equal size, so it's probably a new construction project, 875 square feet per unit, and we're going to assume $60 per square foot. So go ahead and do the calculation. Since everybody's on mute, I'm just going to, for all of these exercises, just give you a few minutes to do the calculation, and then we'll talk through it. And if you have questions about the calculations, we can talk about that as well. So everybody just take about 30 seconds to go through this, and we'll talk about it. Okay, so this is a pretty straightforward calculation. So we would take 40 units times 875 square feet, so that means the total project here would be 35,000 square feet. And then if we're looking at a square foot construction cost in this example at $60 per square foot, we would take the 35,000 square feet times $60 per square foot for a total construction cost of $2,100,000. So if anybody have any questions about that, it's pretty straightforward, just kind of to give you a general idea of how we come up with the construction cost on a per square foot basis. So we just talked about our uses of funds, and now we're going to talk about sources of funds. So our sources of funds must equal the uses. That's pretty basic, and obviously if we're going to build these projects, we have to make sure that we have enough money to pay for everything that we actually have to pay for. So how are we going to pay for these uses? There's two basic ways that we're going to pay for it, debt and equity. So our debt is going to be on a fixed repayment schedule, and our equity is anything that's not on a fixed repayment schedule. And then whatever, because the sources must equal the uses, there's going to be some leftover. So whatever's left over is our financing gap. And typically with our affordable housing projects, the sources of our funds are going to be less than our uses. So we are going to have a financing gap, and we are going to look for different ways that we can fill that gap with different programs that are available. So let's talk about how we can actually come to find out how much debt our projects can afford. So our debt service is a very common term that we're going to be using throughout this webinar. And our debt service really pays our interest plus a portion of the principal on our loan. So this is really similar to a typical monthly home mortgage payment, where you're paying the same amount every month. Some of that's going towards principal, some of it's going towards interest as it continues to pay that mortgage down. So when we're calculating debt service, our debt service formula is the loan amount times the constant. And in this particular webinar, we're going to give you all of the constants, but the constant really is just a formulated table that's based on interest rate and term, and it's really just a weighted average. So this is the table is really a very commonly found and easy to find table. It's standard out there in the industry, and when you get to the actual classroom courses, you'll be looking up the constants on a chart. But in this particular shorter webinar series, we're just going to give you the actual constant. But just to give you an idea, the constant is just a weighted average, and you don't have to worry about how that constant is actually calculated. So our first formula, again, debt service equals the loan amount times the constant. And that's going to give us our annual debt service. So again, the constant multiplied by the loan amount gives us our annual debt service payment. So in this example here, we have a $750,000 loan. We have a 9% interest rate with a 30-year term. So if you were looking at the constant on the chart, you'd be looking at 9% interest rate for a 30-year term, and the chart would show you 0.0966. That's our constant. So to determine the debt service on this particular loan, $750,000 loan times our constant gives us an annual debt service amount of $72,450. So again, this is going to be our annual debt service, and this is going to apply towards both the interest and principal, and that's going to change each month just like a regular monthly home mortgage does. So let's do an exercise for debt service. We're going to do two different exercises, and again, this is just to get you familiar with the math and familiar with these formulas that you'll use quite a bit in the classroom courses. So the first exercise, we're looking at a $300,000 loan, 7.5% interest rate for a 25-year term. So the constant on the chart would be 0.0887. So we're going to calculate the debt service. And again, the formula is there in red for you to refer back to. And on exercise 2, the loan is $1 million, a 10% interest rate, but a shorter 20-year term, and our constant is 0.1159. So go ahead and take a minute to calculate both of these loans, or both of the debt services on both of these loans, and then we'll come back if you have questions. Okay, let's go ahead and talk through the first loan, our $300,000 loan, at a 7.5% interest rate for 25 years. So the first step, as it shows on our formula here, is our loan amount of $300,000 times our constant of 0.0887. So if we take those two, our debt service for the annual amount should come out to $26,610. For our second loan of $1 million, 10% interest rate for a 20-year term. So we're going to take our $1 million loan, multiply that by the constant for our terms of 0.1159. So our annual debt service on the second loan is $115,900. Does anybody have any questions about that calculation? You guys will get real familiar with this calculation, and what we're going to do with these formulas as we go throughout the webinar is kind of show you how we flip-flop these around based on the information that we do have to come up with the numbers that we're looking for. Okay, so let's move on to our developer performance. So determining if an operating project generates enough cash to pay for the debt service on an annual basis. Our developer pro forma, or income and expense statement, is also referred to, includes some main things here that we have listed. So our revenues, so this is going to be our rent. This is going to be the actual rent that we are able to charge on the project on each of the units, including any other income. Other income might include laundry, maybe if there's parking that's being charged for, or garages on site. So all of our rent and other income, and we're going to subtract out of that some vacancy. And no matter how successful we hope that our projects can be, there's always going to be some kind of a vacancy rate that we have to figure in. Then there's also our expenses. We would subtract out our cost of actually operating the development. This is going to include a variety of things: our utilities, our maintenance, everything that it's going to cost to actually operate our project. Then the next step is going to be to determine our debt service, and that's going to be our payments to our lender, and subtracting that out to come up with our net operating income. So that's our bottom line number. So it's our revenues minus our expenses and our debt service, and so that's going to be dollars that are available to pay the lender and our owner or investor. So we can look at a little bit more detail of our pro forma here. Let me froze up here. Give me just a second. Having trouble turning to the next slide. It looks like we don't have our next slide. Let's see, Jose, do you think you can help us get to the next slide here? I'm not able to switch to it.
There are only 13 slides on this deck.
Oh, the one that we had up earlier had all 50. So, I think the best thing to do right now, I know it's a little bit early for a break, but let's just take a 5-minute break, everybody, so we can get the rest of the slides up. Actually, looks like we might. Oh. Yeah, there was a second one up here earlier. Let me try. There we go. I know you guys aren't ready for a break yet. Okay, perfect. Thank you. All right, so this is our little bit more detail of our developer performance for our income and expense statement. So really what we're looking at here is our cash in and our cash out. So again, our cash in is going to be our gross rent. So whenever we're looking at a performer, we're going to calculate the gross fully collected, fully occupied rents that we're looking that we can actually collect on this project. We're going to add to that any other income, again, if there's garages or parking or any other type of income that the project's going to be bringing in, and then subtracting out of that our vacancy factor. And again, we're always going to consider a vacancy factor. That number will lead us to our effective gross rent, so our expected cash rent that we're actually going to be collecting. Then our cash out for our operations, our operating expenses, these are going to be our cash expenses. So we're not going to get into our non-cash expenses in this particular webinar, but you will talk about that in the classroom courses. So in this developer performa, we're only talking about cash expenses, so our taxes, maintenance, insurance, utilities, our management fees, and our replacement reserves. And here we're talking about replacement reserves as a cash expense because it's really money that's put aside similar to a savings account for any non-routine maintenance. So it is going to be a cash expense because it's putting money aside each month. And that's going to lead us to our net operating income, so the cash flow that's actually generated by the property. So let's take a look at this bottom number. The net operating income is a very key number. And what we're going to look at today is the stabilized NOI. So vacancy rates typically in the early years of a project, especially during the lease-up period, are going to be higher. So for example, if you have a rental housing project that has a 15% vacancy rate in year one, let's say the project may be finished construction towards the end of the year, so our year one vacancy rate is going to be 15%. Year two, we're still working on getting that project leased up, so we have a 10% vacancy rate for that second year. And then years 3 and beyond, what we call the stabilized vacancy rate is going to be 7%. So in this particular example, we're saying that the project's going to stabilize at their stabilized vacancy rate in year 3. Well, the lenders, they're making their financing decisions based on a lot of different factors, but it really is part of the amount of the NOI. And the reason stabilized NOI is so important is because it's not, you can't look at your pro forma in year 1 and consider that stabilized NOI because if you see here in this example, that's a 15% vacancy rate. That's not our stabilized number. Year 2 is also not going to be correct because it's a higher vacancy rate. And year 3, we've already figured in some possible raises in rent and some raises in our operating expenses. So year 3 really isn't a stabilized NOI number either. So stabilized NOI is really a function of a few different things, and it's using the stabilized vacancy rate. So just keep in mind that stabilized NOI is the number that we use to calculate our debt that the project can attract from the lender. And again, the example we just looked at, year 1 NOI is going to be really low because of that higher vacancy rate. So you're going to have a lower loan. But the project truly can afford more than that. So the stabilized NOI is the important number to look at. Okay, we have another panelist here today that's going to go through a few slides with you. One of my colleagues, John Lanier. So, John, I'm going to let you go ahead and go through the next few slides.
Okay, so where are we? Oh, we're financing development. Let's talk about putting the money together to pay for all of the costs that have to be paid in order to move the project forward. As Aaron mentioned before, there's really two kinds of money that you can attract for, at least private money, for a project. One is debt. That's money that you borrow and repay out of project income. The other is equity. And equity is money that is contributed by a private investor and with the expectation that it's going to get some sort of return. And the return may be in the form of cash flow, or the return may be in the form of some sort of other benefit like tax benefits. And tax benefits are one of the principal inducements that we have to offer private investors on affordable housing projects. Most of the affordable housing projects that get private investment get investment for things like low-income housing tax credits or historic rehabilitation tax credits. In addition, most affordable housing projects need some third sources of funding, which would be what we call gap financing. It's the money that you need to cover the difference between the costs and whatever you can borrow from private sources and whatever you can raise in equity. So we need to put together the permanent financing. We also have to finance the project while it's under construction. Oftentimes, some lenders do not want to advance money until the project is completed. They'll put the money in when the project is done. But in the meantime, you need to pay for construction costs. You have to pay the contractor, you have to buy land, you have to pay the architect, and so most projects need a construction loan commitment as well. And could you advance this? Thank you very much. All right, so let's talk for a moment about return on equity. And one of the principal measurements of return on equity is what we call cash on cash rate of return, or little e. You'll see it abbreviated as. And what that represents is a property's annual cash flow divided by the amount of cash equity. So if you have, in this particular example, $10,000 in cash flow, that's money that's left over out of rents after you've paid operating expenses and debt service. And let's say that the owner has invested $100,000 of his or her own money, has $100,000 of equity in the project, then the cash-on-cash rate of return is 10%. And what that's telling somebody who's an investor is that if they invest $1, they should be getting back 10 cents in cash flow in this particular year. This is probably the most common way of evaluating return on investment in the multifamily rental housing arena. When most developers decide to do a project, they do it based upon expecting to get a certain cash-on-cash rate of return. And pretty much all conventionally financed, i.e., projects that don't have government subsidies or rent restrictions, are done by developers who are looking for a certain cash-on-cash rate of return. And if you ask me what's a reasonable cash-on-cash rate of return today, I'd say probably somewhere in the 6 to 10% range, depending on the market that you're in. But that means that they'd expect to get about 6 cents to 10 cents in cash flow for every dollar of equity that they invest. Next. Aaron, we need to advance the slide here. Okay. Another concept that's important in figuring out the financing for a rental housing project is the concept of capitalization rates. And you'll hear sometimes people refer to them as cap rates. You'll see capitalization rates symbolized as R sub O. But what this represents is the overall cash return on a rental property. The capitalization rate compares the cash that's available to all sources of capital, both debt and equity, in relation to the amount of cash that's used to pay for the property. So every time a piece of income property, which could be an apartment building, it could be a shopping center, it could be an office building, every time one changes hands, it is sold at a particular capitalization rate. And the rate is simply the relationship between the project's net operating income at that particular time and whatever somebody was willing to pay in cash to buy the property. So, for example, if a property was generating $50,000 a year of net operating income and somebody was willing to pay $1 million to buy it, then an appraiser would say, well, that's sold at a cap rate of 5%. Somebody was willing to pay $1 in purchase price for every 5 cents of net operating income that the property was generating. And one of the things that appraisers do in order to value properties is they keep track of what typical capitalization rates are in particular markets. They actually track sales of properties, and that's how they come up with an appropriate capitalization rate when they're trying to value a property. The market capitalization rate, or market R sub O, is the number of cents of net operating income demanded by a typical investor for every dollar of investment that they're willing to make. So if the market cap rate is 10%, and that would be based upon actually looking at sales of properties and comparing the net operating income that they were generating with the sales prices. If a typical or market cap rate was 10%, it means a typical investor would be willing to pay $1 in purchase price for every 10 cents of net operating income. And the reasoning behind this is that what are investors in income properties seeking when they buy them? Well, they don't really care about how much space they're getting because they're not going to use the space. What they're seeking is an income stream. And the larger the income stream is, the more that they're willing to pay. So let's move on to the next slide. And this is how appraisers arrive at values for apartment buildings or any kind of rental property. The fair market value of any kind of income-producing property is a function of how much income it produces, what its net operating income is, divided by the appropriate capitalization rate. The appropriate capitalization rate is whatever's typical in the market. It could be different between different types of property within a certain metropolitan area. So it could vary within a metropolitan area among different types of property. It's going to vary a great deal also between metropolitan areas. Very strong housing markets like the ones that we have on the West Coast and the East Coast tend to have lower capitalization rates than more flat housing markets like a lot of those in the industrial Midwest. But the way that appraisers arrive at the fair market value of income-producing properties is to compare the property's net operating income with a capitalization rate that they see as typical in the marketplace. So, for example, if an appraiser knows that the market cap rate is about 10%, and he's trying to appraise a project that has $100,000 a year in net operating income, then the appraiser would simply divide the net operating income by the capitalization rate, and that tells him that the property's worth $1 million. And when you think about it, I mean, this is all very logical. Why do people buy income-producing properties? Well, they buy them to get income. And the more income that a property generates, the more investors are willing to pay. The more they get, they're more than willing to pay for what they get. And what a capitalization rate does is it allows us to convert the income stream from a piece of rental property into a value today. So in this example, the fair market value is $1 million. Let's move to the next slide. Now, so that is one of the ways that equity investors determine how much money they're willing to loan on how much money they're willing to invest in a piece of income-producing property. It's the amount of cash flow that comes back to them. Let's talk about lenders. And there's a few basic ratios, really two principal ratios that permanent lenders use in order to determine how much money they're willing to loan. And every lender, when they make a loan, is first and foremost concerned about how they're going to get paid back. If I loan somebody money as a lender, my first question is, how are you going to pay me back? And the answer to that is, I'm going to pay you back out of net operating income. And so there are two ratios that are used. One is what we call a debt coverage ratio, or sometimes it's called a debt service coverage ratio. And the other ratio that is the primary determinant of the loan amount is the loan-to-value ratio. Debt coverage ratio compares the amount of debt service on the property to the amount of income that's available to repay the debt service. The loan-to-value ratio compares the loan amount to the fair market value of the property. And most lenders are going to underwrite using both of these ratios. They're going to make a calculation of how much money they can loan and stay within a certain loan-to-value ratio that they want to meet, and they're going to look at how much money they can loan and stay within a certain debt coverage ratio that they want to meet. And then whichever amount that they arrive at under these two, whichever is lower under the two ratios, is going to determine the loan amount. Okay, next. Debt coverage ratio is, what we're trying to measure here is how much money is available to repay the loan in comparison to what has to be paid. What has to be paid is the debt service. What's available to repay the loan is the property's net operating income. And so the debt coverage ratio compares net operating income to debt service. So, for example, if we have a debt coverage ratio on a property of 1.15, it means that for every dollar of debt service that has to be paid, there is about $1.15 of net operating income. So what you're really saying is that the lender expects there to be about 15% more income than is going to be required to repay the loan. And the reason that lenders care about that is that that additional 15 cents is margin for error. Lenders know that bad things can happen. Vacancies can go up. Expenses can go up. So every lender wants to see some margin for error, and one of the ways that they create it is through the debt coverage ratio. So I would say today most lenders are looking for, it's unusual to see lenders making loans with coverage ratios of as little as 1.1. For many, many years, that was HUD's underwriting ratio for the FHA 221D4 program. But I would say today that most lenders are going to be looking for 1.15 or 1.2 and up, depending upon the nature of the project. So let's use debt coverage to calculate a loan amount. Let's assume that a bank wants a 1.15 coverage ratio, and let's assume that a project has projected net operating income of $111,200 per year, and that they're making loans at 8% for 30 years. First, what a lender is going to do is figure out the maximum debt service that they're willing to allow. And the way they do that is they divide the stabilized NOI, that's the money that's available to repay the loan, by the coverage ratio that they want. In this example, if you have $111,200 of NOI and divide it by 1.15, then that means that the maximum debt service that they can allow and achieve the ratio, the coverage ratio that they're looking for, is $96,696. So what the lender's really doing when they use debt coverage as an underwriting tool is they're trying to limit the amount of debt service so that there's a comfortable amount of net operating income above debt service in case something bad happens. And as we all know, bad things happen every now and then. So if they limit the amount of debt service to $96,696, the next question is, well, how big a loan can you repay with that amount of debt service? And all you have to do is divide it by the constant for the rate and term that the lender is offering. This lender is offering loans at 8% for 30 years. The constant on that is 0.0881, which really means that for every dollar you borrow, you're going to pay back 8.81 cents per year. If we divide that into the amount of debt service the lender is willing to permit, $96,696, you come up with a maximum loan amount of $1,097,567. So, how do lenders figure out how much they're willing to loan? Well, one of the ways they do it is by calculating the debt coverage ratio and using that as a limit on the amount of debt service. And by limiting the amount of debt service, it limits the amount of the loan. So that's one ratio. Now let's do a little exercise here. Let's assume that a lender is looking for a ratio of 1.20. That means they want to see $1.20 of income for every dollar of debt service. And let's assume that a project has $100,000 of net operating income, and the lender is willing to make a loan at 7% with a 25-year term. The constant for that rate and term is 8.49%. What I'd like you to do is first calculate the amount of debt service they're willing to allow, and that means dividing the stabilized NOI by their coverage ratio. And then next, calculate the loan amount, which means take that debt service figure you just calculated and divide it by the mortgage constant, and that will tell you how much they can loan and still stay within their debt coverage ratio. So everybody take a couple of minutes here and do this calculation.
Okay, we're going to switch back up here, and I'm going to go over the solution here. So hopefully everybody has some time to get through their calculation. So our first step is to solve for our debt service. So our debt service is our stabilized NOI, which was given to us of $100,000, over our debt coverage ratio that the bank is requiring of 1.20. So if we take $100,000 divided by the 1.2, we get a debt service of $833,333. And I want to make one point here that in the classroom course, as well as any other courses, including this webinar, you're more than welcome to round, and everybody's calculator is going to get a slightly different number. So just keep that in mind, and you'll hear that a lot during the classroom course as well. So as long as your number's in this ballpark, you're on the right track. Okay, so the debt service number then to determine our loan needs to be divided by the constant for the 7% 25-year term, so 0.0849. So if we take that number, our loan amount should come out to around $981,547. And just a reminder, if anybody has questions as we go along, feel free to ask those in the chat area. So the other lender ratio that John had mentioned was the loan-to-value ratio. So we're going to look at an example of that. So again, this is really representing the lender's second way out. So if something were to go wrong with the project and it were to be foreclosed and there was an actual sale of the asset, this is the way that they would be retained. So really their goal is to make sure that the resale value is more than the actual loan balance. So typical loan-to-value ratios, 75 to 80%. That's probably 80% is probably a little bit high, and again, it's going to depend on the marketplace and depend on the way that the economy is doing and how conservative the lender is being. So keeping in mind that the lender's loan amount has to meet both debt coverage ratio and loan-to-value, the formula for loan-to-value is our loan amount divided by our fair market value. So in this example, the lender is offering the 7% 25-year loan, and the debt coverage ratio, again, is 1.20. The loan-to-value ratio in this example is 80%. So the developer of an affordable rental project is asking for a $1.1 million loan based on the following pro forma and a stabilized NOI of $100,000. So we're going to look at both the debt coverage ratio and the loan-to-value ratio and compare both, because, again, the bank's going to look at both and they're going to lend on whichever loan covers both, so it's always going to be the lower number. So for our debt coverage ratio, we're going to start with our debt service, which is our loan times our constant. So the request of the loan is $1.1 million, and the constant here is 0.0849. So the debt service on that would be $93,390. The pro forma shows us that our stabilized NOI is $100,000 divided by the debt service of the requested loan of $93,390 means our debt coverage ratio is only 1.07. Again, the lender is saying that their requirement is 1.2. So if we're requesting a $1.1 million loan, the lender is not going to grant that request because we have such a small margin for error here with our 1.07 debt coverage ratio. So the way to determine what we can actually afford is to take our NOI again, $100,000, and divide that by the required debt coverage ratio of the lender of 1.2. So the debt service that we can actually afford to meet that criteria is $83,333. Not $93,390, which is what would have been the debt service on the loan we requested. So to determine how much of a loan we can actually get based on that debt service, we're going to take our debt service divided by our constant, and that shows that we can actually, to meet that lender requirement, only afford to borrow $981,543. So again, this is just switching around some of the formulas based on the information that we have to get to the actual number that we need. So instead of a $1.1 million loan, to meet the lender's criteria, we can only borrow $981,543. And that's just for the debt coverage ratio. So let's look at our loan-to-value ratio. In this example, the lender knows that the market cap rate is 0.085. So our fair market value, which we looked at the formula before, is the NOI over the market cap rate, so $100,000 divided by 0.085. So the fair market value for this project is $1,176,470. To determine the loan-to-value, the loan amount that we're requesting, again, is $1.1 million. Divide that by the fair market value. That's a 94% loan-to-value ratio. Again, that's not enough margin for error for the lender. The lender has told us that they want the loan-to-value ratio to at least be 80% or below. So we're going to flip our formula around and determine, based on loan-to-value, what we can actually borrow from the bank. So our fair market value, $1,176,470, times the actual loan-to-value ratio that the bank is requiring of 0.80, gives us a loan amount of $941,176. And remember, the bank is going to look at both our loan-to-value ratio and our debt coverage ratio. So if we look at the conclusion of both of those, our debt coverage ratio shows that we could borrow $981,543. Using our loan-to-value, the maximum loan is $941,176. So the loan amount that's going to meet both of the lender's required criteria is going to be the lower number. So $941,176 is what we can actually borrow, not $1.1 million. So just keep in mind, again, that lenders are going to look at both ratios. You're going to calculate both, and for both ratios to be met, it's always going to be the lower number. So this is going to be a good spot for us to just take a short break for you all to do whatever you need to do. We're just going to take a quick 5-minute break and come back. My clock shows 5 after, so let's come back at 10 after and we'll get started right back up. And if anybody has questions in between during the break, again, feel free to put those into the chat.
Erin?
Yes.
This is Gail. There are 2 people that do have questions, Erica from Healthy Neighborhoods and Richard from HUD.
Okay. And do you have the actual questions?
I do not have the actual questions. They're not in the chat.
Okay. If it's possible to put your questions into the chat, and when it shows send to, just choose choose all panelists and send those questions, then we can go ahead and address those. It looks like some of the, I see a few people have asked questions about the availability of this, the handouts, the slides, and those will be, those will be available in a couple of days. Is that correct?
That's correct. They should be available within the next couple of days on the event center. Okay, no, that's not right. I have my notes right here. On the resource exchange, they should be available within the next 48 hours.
I spaced out on the name of that, too. The resource exchange, so those will be available in a couple of days. Okay, I'm going to go ahead and answer a couple of questions that have come through before we get started back up. And there was one question from Yvette, and I sent an additional question back to you, so if you can look that over and let me know, then I can try to address your question. And I have a question here from Bob Jones, a great question. If gap financing is a loan and not a grant, do the banks factor the debt service for the additional loans and reduce their loan amounts down because of the secondary debt payments, or do they just consider their own loan debt service? And really the answer to that when we're looking at these initial lender requirements is that this is going to be our first lender. This is going to be our primary first mortgage. So they're going to just be looking at, because when we were talking earlier about the multi-party agreement, the first mortgage lender is going to be the person who gets paid back first if something goes wrong with the loan, if something goes wrong with the project. So in these particular examples, we're looking at our first mortgage, and so this particular lender is only going to be looking at the first NOI because they know they're going to get paid first. If we start getting into looking at our gap financing, which is what you're talking about with the other lenders that may require some payback, they are going to consider other loans that are being, let me see if I can go back to our developer spreadsheet slide, just to kind of give you an example. Let me see what slide that was on. Because they are going to look at the debt service that's being paid to the other loans before they consider how much they're going to pay. Pretty early on here. Sorry for fumbling back here. So let me show us back at the developer pro forma here. Slide 14. Okay. Okay, so if we look at this developer pro forma, and this is a simplified version, what the lenders are going to be looking at, again, is getting down here to the net operating income. And then from net operating income, we're going to subtract out debt service. So if you've now gone to look for some gap financing, they are going to now be looking at a lower NOI because they're going to subtract it out the debt service that you've obtained from that first mortgage lender. So it is going to, make a difference on your any other additional financing that you get, and that's really why these, your first lender is going to be the biggest source of loan on the project. Hopefully that answers your question. If not, feel free to add more into the panel there. Okay. And I'm going to just go over the debt coverage exercise for a couple people again just real quickly and hopefully clear up some questions. So let's see. Okay, so just a quick reminder here for our debt coverage ratio, calculating the loan amount. Again, what we're doing here is looking at different examples of ways that you can switch around the calculations to get the number that you're looking for. So if your debt coverage ratio required by the lender is 1.15, to solve for debt service, you're going to already know your stabilized NOI number from the pro forma that you put together, and you're going to divide that by what the lender is requiring for the debt coverage ratio. That determines what our debt service is that the project can afford. So we know that from our pro forma we put together that $111,200 is the stabilized NOI divided by the debt coverage ratio of 1.15. So our debt service that we can afford and still be able to have a 15-cent cushion for that lender is $96,696. And from there, we switch the numbers around to determine our loan. So our debt service then of $96,696 divided by the constant, which the lender has given us an 8% term of 30 years, means that the loan that we can afford is $1,097,567. And so on that actual almost $1.1 million loan, our debt service, what we actually have to pay on an annual basis, will be the $96,696. And hopefully that cleared that up a little bit. We are going to go through another example at the end of the slideshow that will go through the lender ratio analysis again. And if there's additional questions, I'm more than happy to look at those again at the end of the webinar. And you're also my contact information will be there that you can call and ask more specific questions. I know it's a little bit difficult sometimes to ask questions through the just through the panel of the question and answer on here. So I just want to make sure I'm getting these addressed right. So, okay, great. And the question that I just got was how we get the value for C for the constant, and really it's the C is the standard table. They're out. You guys will use them in the classroom session, and they're based on the actual interest rate and the actual term of the loan. And so it's really just a simple matter of looking it up on a table. And just because we have a limited time here in the webinar, we're giving you the constant, but in the classroom session, you'll look it up. It's just a weighted average, and it's not something that you'll actually end up calculating. So it just comes from a standard table. Okay, so just kind of a reminder here of our deal structuring, our project costs, which is our uses, again, determined by that development budget, and then our sources, so our debt and equity. And we just got done looking at how we figure out the debt that can be attracted to the project. And then the financing gap. And this financing gap is going to become something that is looked into in a lot more detail in the classroom courses, determining how those gaps can be filled in the different programs that are out there. Again, the financing gap is very typical for affordable housing projects, so more than likely there is going to be a financing gap needing to fill. And again, I know we had a question about the gap, and it is going to be considered what that first loan is, that first set of debt service on the project, because obviously that's less cash available. Once that must-pay debt has been paid, that's less cash that's going to be available to pay any gap financing. So it will be considered when determining the loan amount for the gap financing, even if it's must-pay. Okay, so let's go into some home ownership finance. Home ownership finance really has two main problems. It's affordability and lack of investment. So affordability, really we're talking about households that can't pay the cost of housing. So neighborhood residents don't have the incomes that can actually pay the mortgage for the house, plus the insurance and the taxes. And then obviously there's also lack of investment. So costs are going to be exceeding what people are actually willing to pay. Cost to build a house, paying for street improvements, providing water, sewer, especially with new construction, providing all of that, those costs are really high. And so families can't afford it. And if you think about it, the costs for a particular area aren't based on the neighborhood, they're based on that particular area. So whether it's a distressed neighborhood or it's a wealthy suburb, it's still, the construction costs in that area are still going to be the same. So lack of investment is really a key issue in home ownership finance. So a couple of solutions, reducing some development costs. That can possibly be done through land donation. If the land isn't already owned by the developer, finding ways to get that land at a lower cost or possibly to get it donated. If it's a real blighted area and the city owns the land, maybe they will be willing to donate at least a portion of it in return for knowing that this development is going to really help to bring some more people into the neighborhood and make the neighborhood more attractive. Possibly impact fee rebates for utility and connection fees. Obviously looking at reducing the cost of capital, increasing the availability of capital, And really, there's two financing approaches. So we're looking both at financing the actual development, which is the construction loan, and financing the purchase for the actual home buyer. So actually helping to finance the mortgage. And really, the mortgage is our takeout. Again, just as we just talked about on rental housing, our construction loan is paid off by our permanent financing. Same here with homeownership finance. Our construction loan is taken out by the mortgage of the home buyer. And really, we're looking in this homeownership finance to subsidize both the financing of the development and the financing of the home buyer. So talking about the construction loan, loan to the single-family house, again, just like rental housing, this is just for a specific term and a specific interest rate. So it's just during the actual period of construction. And then once it's completed, then it's going to be repaid with the actual mortgage of the home buyer. There's going to be construction interest that's going to accrue during the loan term. And again, once there's rental revenue available, once the mortgage is actually in place, then the construction loan can be paid off. So really, we're looking for a project if it has basic viability, looking at the profit and loss to determine whether it truly has that viability. Is the revenue going to exceed both the debt and equity invested? That should say both instead of and. The profit and loss statement is going to give us that rough estimate of that viability. And this is, again, runs fairly parallel with the idea of the rental housing when you're looking at the viability of these projects and looking at the actual loans and how they're paid off from construction to a permanent loan. For single-family housing, this is a basic profit and loss statement. So really the revenue for single-family housing is going to be the actual sale of the housing unit versus the rental income that comes in on a rental project. And then from the sale of the housing units, just like we subtract out vacancy on rental housing, we would subtract out the selling cost. So, a realtor's percentage paid on selling the house, whatever cost it takes to get those houses sold is going to come out, and that's usually going to be a percentage. So that's going to be the total revenue for single-family housing. As far as our costs, we're still looking at land acquisition. We're still looking at planning and engineering, site improvements that may be needed. Again, if the project doesn't have utilities yet that are at the site, if there's any environmental issues that need to be addressed, those site improvements are part of our costs for our single-family housing. The actual construction of the houses, and then our fees and other soft costs. Those are going to come to our subtotal, and then we have estimated financing costs that we would have to add in there as well to have our total costs. And the financing costs, again, are going to be based on our construction loan during that construction period. So we will take our total revenue minus our total cost, and that's going to be the developer return, which is also the subsidy that's required. And so this is just, there's definitely a limitation with this profit and loss statement because it does ignore timing. But this is just kind of a basic profit and loss statement, and this is a form that you'll get familiar with again in the classroom course, the HT 410 course. So let's look at some of the sources of our construction financing. As with the rental housing, we're looking at typical banks, also looking at government financing programs. With our homeownership finance, we're also looking maybe at affordable housing programs of the Federal Home Loan Bank. And really, AHP provides grants and subsidized loans that help support both affordable and rental housing, and also home ownership opportunities. So that's one great source of potential uses and finding ways to get some construction financing. The AHP funds can cover home buyer pre- and post-purchase counseling, depending on the area and what you're looking to provide. They can provide home buyer down payment or closing cost assistance. Also can help to cover acquisition, new construction, or rehab. Also subordinated seller financing. Also would be looking for equity, and also staged land purchase could be a possibility with homeownership finance. And remember, we talked about subsidizing both the, what we're really looking at is two financing approaches here, both financing the development and financing the purchase for the home buyer, and really looking to subsidize both of those. So subsidizing the construction financing, but also trying to find ways to subsidize the mortgage loan for the home buyer. And again, this is going to be our takeout. This is going to be our permanent loan that's going to take out that construction loan. So financing for the actual buyer. We're looking here, just like we had talked about previously, our mortgage payments on the homeownership is going to include both principal and interest. So we're looking at PITI, which is principal, interest, taxes, and insurance. And again, it's just like we had talked about before. We're going to have a monthly debt service amount that the homeowner is going to be looking at, and that monthly debt service is going to pay for both the principal and the interest on the loan, and it's just going to vary each month how much is going towards principal and how much is going towards interest. So we're looking at the debt service on the mortgage, we're looking for the payment of the annual property taxes, the property insurance, and if applicable, the mortgage insurance. So all of those components are going to go into the actual payment. Okay, and we have a great question here, and I'm not sure that I can answer it, but I will get the answer for you. The question is, if we're subsidizing a portion of the mortgage loan for the actual homeowner, do we need to be licensed as a lender by the Department of Corporations and or DRE? I'm not familiar enough with the homeownership, but I can find out the answer to that question for you. Okay, so let's look at debt capacity. So the maximum amount that an individual or family can borrow. So this is our monthly debt service, and here we're looking at essentially what can the homeowner afford each month. This is really what we're going to determine. So instead of using on our rental housing, we were looking at the net operating income that the project's bringing in. Here, to determine debt capacity, we're looking at how much can the homeowner afford each month. So we look at that as their monthly debt service, multiply that by 12, and then we divide that by the constant of the loan that's going to be offered. So in this particular exercise, we're going to use the formula in red and do the exercise with a monthly debt service, so saying that the homeowner can afford $450 a month. The bank has offered lending terms that lead us to a constant of 0.0966. So let's determine what the actual debt capacity is for this particular household using the formula above. So again, I'm going to give you guys a few seconds to do this calculation, and then we'll talk through it. Okay, so let's go through the calculation for debt capacity on the home ownership. So we've got our monthly debt service that the homeowner can afford of $450 a month. They're going to pay that because we need to get to an annual amount, so we multiply that by 12. So we get $5,400 annually. and then we're going to divide that by the constant based on the loan term, so 0.0966. And again, you guys can look those up on the table in the classroom, but here we're just providing those. So the debt capacity for this particular example is $55,901. Okay, so again, this is very similar to the calculations we did for rental housing. It's just that what we're using here is the monthly debt service that the individual can afford multiplied by 12 versus the net operating income, which we would use for rental housing. So when we're talking about qualifying buyers, we're really looking at how much can the buyer pay for the house. So loan-to-value ratio is still another consideration here, and really that's just the percentage of the purchase price that the lender is going to finance. And it's the same concept as what we looked at previously with the rental housing. So it's looking at how much can the lender make if the home were to be foreclosed on, and they want to make sure that their loan balance is less than what the actual house can sell for. Then they're also going to look at housing expense to income, which is considered the first ratio, or you may have heard it as the front ratio. And this is really looking at typical income, regular recurring income that comes into a household. So salaries and wages, self-employment, Social Security. Again, any typical regular basis type of income is considered into your first ratio or your front ratio. And on average, that's going to be somewhere in the ballpark of 30%, 28% to 32%, somewhere in there typically is the housing expense first ratio that a lender is going to look at. Then the other ratio is our recurring debt to income, or our second ratio, and that's also considered the back ratio. So this is our entire total debt divided by our income. So this percentage is going to be a little bit higher, maybe 33 to 45%, really depending on the area. And this is really the sum of all housing expenses plus debt. So it's going to be loan payments, it's going to be any job-related expenses, maybe child support, any total recurring monthly obligations are going to be considered into the second ratio. And then looking at the creditworthiness of the buyer. And pretty much probably 75% of all mortgage applications are looking at creditworthiness, and it's really just an automated evaluation tool that's out there. Any conventional mortgage is obviously going to be more conservative with these different types of ratios and creditworthiness, and there's a variety of programs that are out there that are used for affordable home buyers. And in the classroom session, a lot of those will be discussed in more detail. There's Veterans Affairs programs, Fannie Mae and Freddie Mac have programs, there's rural housing programs, the FHA lending programs. So there's a lot of different types of affordable homeownership programs that are available out there that are going to have a little bit different lender ratios and really help to subsidize these home buyers for the affordable housing. Okay, we're going to get a little bit more practice with some of our calculations here and look through a case study. And it's a little bit difficult to do too much of an in-depth case study in the webinar only because there's flipping back and forth of looking at different information. So we're going to do our best here to kind of go through this and then kind of put everything of our assumptions together and just kind of walk through some more calculations. You'll get real used to case studies in the classroom courses and lots of practice with this stuff. So this case study is called Golden Street. So Boiling Springs Baptist Church, located in the Austinburg neighborhood of Macon, Georgia, has made neighborhood improvement a high priority. Church members are currently focusing their efforts on Austinburg's main thoroughfare, Golden Street, and the development of affordable rental housing opportunities for local families. A rental housing development that would be affordable to families at 50% of area median income is being proposed. So the project, A Far Better Place Apartments, will provide homes for 50 families. The development is going to have 21 bedrooms and 32 bedroom apartments. So here we have a development budget that includes a lot of the pieces that we've talked about. So we obviously have our land, we have our on-site improvements, our actual construction for the new construction is $5.5 million. This particular example for new construction, they felt a 5% contingency was adequate, so $275,000 here for contingency. We have our survey, our architect and engineering fees, our real estate attorney, our developer fee. Again, there's always going to be a developer fee built in here. Syndication expenses, construction loan interest. Again, that's the interest just during the term of the construction. The construction loan fee, the appraisal, and then we have some permanent loan fees that are being built into our development budget. We have marketing expenses. Obviously, we're going to have to market the project to begin lease up as soon as the construction is done, and then an operating reserve. So our total development budget in this particular example is $7,770,000. So our operating budget, again on our day-to-day operations, the rents for the two unit types are $525 and $675 respectively. Tenants are responsible for all utilities. If you were looking at your pro forma, the rents, we would increase those at a rate of 2% each year. And then operating expenses, we would look at those for increasing 3% each year. And our replacement reserves, again, remember, those are part of the operating budget because they're a cash expense that we're putting aside each year to make sure that we have money for any unexpected items or replacement of any major systems. The replacement reserves are going to be increasing at 3% per year. The market study is indicating that the vacancy rate is 10% the first year during lease-up and then stabilizes at 7% in subsequent years. So our first year operating budget, we're looking at our advertising, our management fee, legal fees, administrative, our utilities of $15,000, maintenance, real estate taxes, again, those will be paid every year, our insurance of $20,000, and then our replacement reserves. And even though we had said previously that the tenants are responsible for the utilities, in this example for our operating budget, we still have utilities of common areas in any vacant unit, so that's what's being built in here. So our total operating budget, our total operating expenses are $150,000. So let's look at an example for financing. So North Babylonian Bank and Trust is willing to make a 30-year loan with an interest rate of 6% as long as the debt coverage is at least 1.15, and it's assumed that the cap rate is 10%. So the assignment is going to be to review the operating budget information of Far Better Place Apartments and determine what is the stabilized net operating income. And remember, stabilized net operating income, we have to determine how much rent we can bring into the project. So the rent amount was determined, and we'll show you a reminder of how much rent there was for each unit. And we didn't show any other example in this, any other income in this particular example. So there may be other income on your project, but for ease of simplicity on this case study, we're not considering any other income. So we're taking our actual amount that we can bring in for rent, subtracting out our vacancy rate to determine our stabilized NOI, and subtracting out our operating expenses. And then we are going to look at how much debt we can attract based on the debt coverage ratio that the bank gave us, and looking at initially what the gap is, because we did look at a total development budget. Okay, so here's the assumptions as a reminder. We have 50 units total, 20 of them are one bedrooms, and those are renting for $525 a month. 30 of them are two bedrooms, renting for $675 a month. Our first year vacancy rate is 10%, and our stabilized vacancy rate is 7%. So remember, when we're calculating stabilized NOI, we're using our stabilized vacancy rate. Operating expenses, we had a handful of cash expenses, including advertising, utilities, insurance. Those came out to $135,000, and we also have our replacement reserve of $15,000. So to get to the stabilized NOI, we need to look at how much our total rent revenue is, subtract out our stabilized vacancy rate, and subtract out our cash expenses, our total operating expenses and reserves. And So I'm going to keep it on this page while you guys do that calculation, because we have to get to our stabilized NOI before we can do the second step, which is to determine the debt that can be attracted. So I'll give you guys a minute to do that, and we can talk through it. But again, remember to determine it, we need to calculate out our 21-bedroom unit at $525 a month. Remember that's a monthly amount, so we need to get to annual and calculate the rent for our 2 bedrooms as well. So that's going to be our total gross rent, and we're going to subtract from that 7% for our vacancy. And then subtract from that the total operating expenses. Okay, so I'm going to skip ahead here so we can look at how we get to this number. Okay, so again, we're looking at our cash in and our cash out. So we were told that $525 a month. We have 20 units, and there's 12 months worth of rent collection, so $126,000. Then on our 2 bedrooms of $675 a month, we had this says 20 units. I think I did that number wrong. Times 12 months, so $243,000. And this is actually 30 units. The answer of 243 is for 30 units. Okay, so then from that, these two numbers together give us our gross rent. We subtract out of that a stabilized vacancy rate of 7%. Okay, so $25,830. That's all the cash that's coming in. So that's the actual cash collected coming in, and then we have our expenses. So we've taken our gross rent here, subtracted out our vacancy factor to get effective gross rent of $343,170, and our cash out is our $135 operating expenses and $15,000 in reserves. So our net operating income, once we subtract those out of our effective gross rent, gives us a stabilized NOI of $193,170. So this is again a big number that's really important to be able to do the calculation for debt coverage ratio requirements from the lender, and you'll get real familiar with this. Use this calculation quite a bit in the classroom session. So let's go back to the next question that was in our case study, which is what the bank is willing to offer us. So First Babylonian Bank and Trust is willing to make a 30-year loan with an interest rate of 6% as long as debt coverage is at least 1.15. So the constant for this rate and term is 0.0720. We're not going to use the total project cost quite yet, so both calculations, formulas there in red, can be used to determine our number. And I'm going to just so that if you guys can't flip back and forth, in case you didn't get a chance to calculate the stabilized NOI, I'm going to type that in here to the Q&A area so that you can, or to the chat area. 193,170 is our stabilized NOI. And remember, that's what we use to determine our loans. I'll give you a minute to do this part. Okay, let's start going through this. And again, I realize that it's a little bit difficult to know when you guys are completed with doing the calculations. So I hope that I'm not moving along too fast, but I want to make sure that we get through everything and we're able to answer questions as well. So again, this is another exercise similar to what we've done. So we've got our debt service equals the stabilized NOI over our debt coverage ratio. So our stabilized NOI we have calculated and determined as 193,170. We're going to divide that by the bank's required debt coverage ratio of 1.15, which means that our debt service for this loan is $167,974. So from that, that's our annual amount of debt service. We can convert that into what the actual loan amount will be. So the loan is our debt service divided by our constant, and when we take the debt service divided by 0.0720, we get a loan amount of $2,332,972. Okay, so again, this is saying that the bank has required us to have a cushion. They want their cushion of 15 cents per dollar of net operating income that we have coming in. So they're asking for 1.15 debt coverage ratio, and based on the stabilized NOI that we have, we've come up with a loan amount of $2,332,972. So you'll remember our total project costs were $7,770,000. So if we're going to look for, the next question was, what's the initial gap based on this calculation? And we didn't do a loan to value on this particular one. So our initial gap really is just our total project cost of $7,770,000 minus the first loan that we've looked at here. So our first loan of $2,332,972. Right? So really, the reality is that this is a pretty big gap still. Our gap right now is $5,437,028. Okay, and there's a whole lot of affordable housing programs out there, and there's a lot of programs, especially the low-income housing tax credit program, that provides tax benefits to investors because affordable housing projects really don't have a lot of cash coming in, which is, again, why we have lower loan amounts. We're looking at rents on these projects. This particular example, our rents are $525 and $675 a month. So because that's the cash that's coming into us, and that's what our lender is giving us a loan based on, our loan amounts are going to be smaller on affordable housing projects. So we've got to find some other incentives to bring some money into our projects. And one of the big programs out there is the Section 42 Low-Income Housing Tax Credit Program. And in the HD 420 course, you'll go through a lot of more detail of how that program can really reduce this gap a lot by bringing a lot of equity into the project, and in return, the investor is getting tax benefits versus actual cash flow, because again, there's not a lot of cash flow in these affordable housing projects. So hopefully the webinar today gave you at least a general idea and some at least some examples of the different calculations and formulas and some of the terms that you're going to hear in both the 410 and 420 courses, classroom courses, and really got you familiar with some of the basic tools and techniques of development finance, and sharpened up a little bit of your math skills. You'll be doing a lot more math in the courses coming up in the classrooms. My contact information is here. If there's any questions that were not answered, the one question about the subsidizing the portion of the mortgage for the loan, I'm going to get back to you on that individually, but if there's any other questions that weren't asked yet that you would like to, call or email about, feel free to contact me at any time. And just as a reminder, these will be available in the next 48 hours on the Resource Exchange website. These slides will be. So does anybody have any other questions? If nobody has any other questions, that's all that we have for you today on the webinar. We're going to stick around, so if you you come up with some questions, feel free to go ahead and ask those, type those into the Q&A area, and we'll be here to answer those. So thank you, everybody, for joining today.